Ladies and gentlemen, imagine waking up one morning and realizing that something quietly dramatic has been unfolding behind the scenes of the global financial system. Not on the front pages, not on mainstream headlines, but deep inside the plumbing of the metals market. A steady drain, a silent shift, and suddenly the numbers begin to tell a story that hasn't been told in years. According to recent market chatter, inventories connected to the COMEX system have been tightening while the concentration of major short positions, often referred to as the Big Eight, has reportedly dropped to levels not seen in nearly 17 years. Now think about what that means for a moment. If a market that has long been dominated by large short positions begins to see those positions shrink, and at the same time physical supply appears to be moving out of exchange vaults, something important may be developing beneath the surface. And when traders talk about the possibility of a forced cover, especially heading into a critical Friday close, they're really talking about pressure. Pressure that can sometimes cause markets to move faster than anyone expects. This is why today's discussion matters. The title alone captures a fascinating convergence. COMEX drain accelerates. Big 8 shorts at 17-year low. Friday's forced cover could gap silver. It sounds dramatic, but behind that drama is a deeper lesson about how markets function, how supply and demand interact, and how structural changes can build quietly for months or even years before they finally show themselves in price movements. Whether you follow precious metals closely or you simply care about understanding the global financial system, moments like these offer a window into how confidence, liquidity, and positioning interact in real time. Because markets are not just charts and numbers. They are reflections of human behavior, institutional strategy, and the shifting balance between paper claims and physical reality. Consider the first key idea, the concept of a drain. In commodity markets, the term refers to inventory leaving the exchange system. Metals move from registered categories into private ownership, industrial use, or long-term storage. When inventories decline steadily, it can signal tightening supply within the exchange ecosystem. Think of it like water slowly draining from a reservoir that feeds multiple cities. As long as the reservoir stays full, everyone feels comfortable. But if the water level starts dropping faster than expected, suddenly people begin asking important questions. How much supply is really available? How quickly can it be replenished? And what happens if demand unexpectedly surges at the same time? This is where the narrative becomes interesting. For years, analysts have debated the relationship between physical metal and the futures market that trades contracts representing that metal. The futures market is designed to provide liquidity and price discovery, allowing producers, manufacturers, and financial participants to hedge risk. But when the balance between physical supply and paper claims shifts too far in one direction, the market can become more sensitive to sudden moves. Not necessarily explosive moves, but moves that surprise people who assumed conditions would remain stable. Now layer on the second element mentioned in the title, the Big 8 shorts reaching a 17-year low. In simple terms, large short positions represent participants betting on or hedging against falling prices. Historically, a small group of major institutions has often held significant short exposure in metals futures markets. When the concentration of those positions declines, it can indicate a structural change in positioning. Maybe risk models are shifting. Maybe institutions are reducing exposure because volatility has increased, or perhaps the broader macro environment is making certain strategies less attractive than they were before. Whatever the reason, when large participants adjust their positioning, the ripple effects can be felt across the entire market. Picture a crowded theater where everyone is standing in roughly the same position near the exit doors. If nothing happens, the crowd remains stable. But if even a portion of that crowd begins moving in a different direction, the entire dynamic changes. That's the nature of positioning in financial markets. It's not just about what people believe, it's about where they are already standing when the next development occurs. Now let's think about the phrase forced cover. In trading language, covering means closing a short position by buying back contracts. When traders are comfortable and markets are calm, covering happens gradually. But if prices begin rising faster than expected, short sellers may rush to close positions in order to limit risk. That process can create additional buying pressure, sometimes accelerating price moves in the short term. It's not magic, and it's not guaranteed. But historically, many markets have experienced periods where rapid covering amplifies momentum. And when people mention the possibility of a gap, they're talking about a price jump between trading sessions. Imagine the market closing on Thursday evening at one level and reopening Friday morning at a noticeably higher level because overnight developments forced participants to reposition quickly. Gaps occur in many markets, from stocks to commodities to currencies, and they remind us that liquidity and sentiment can change faster than expected. But beyond the technical mechanics lies a bigger lesson about awareness. Markets reward those who take the time to understand structure rather than simply reacting to headlines. When you hear phrases like inventory drain, short concentration, or forced covering, it's an invitation to look deeper into how the system actually works. Because real financial literacy isn't about predicting tomorrow's price, it's about understanding the forces that shape long-term trends. For example, silver occupies a unique position among global commodities. It is both an industrial metal and a monetary metal. It plays a role in electronics, solar technology, medical equipment, and advanced manufacturing, while also carrying centuries of history as a store of value. This dual identity means its market dynamics often reflect both economic activity and investor sentiment. When industrial demand strengthens, silver can benefit. When investors seek diversification or protection against uncertainty, silver can also attract attention. And that dual nature is exactly why developments inside the futures market attract so much discussion. If physical demand remains steady or increases while certain forms of speculative pressure decline, analysts begin asking whether the price discovery mechanism could gradually shift. Not overnight, not in a dramatic cinematic moment, but slowly, through a series of adjustments that change how participants interact with the market. Another important takeaway here is the concept of patience. Financial history repeatedly shows that structural shifts take time to unfold. The most significant changes rarely happen in a single day. They build quietly through inventory flows, policy decisions, technological demand, and institutional positioning. Then eventually, the broader public notices only after the groundwork has already been laid. Think about the way tides move in the ocean. Standing on the shore, it might seem like the waterline barely changes minute by minute, but return 6 hours later and the entire shoreline looks different. Markets behave in similar ways. Small changes accumulate until suddenly the landscape appears transformed. For viewers who are trying to improve their financial awareness, one of the most valuable habits is learning how to track structural indicators rather than focusing only on price charts. That could include watching inventory reports, understanding open interest, observing how institutional positioning evolves, and studying how global supply chains influence commodities. None of these elements alone predicts the future, but together they create a clearer picture of the environment in which markets operate. Another useful mindset shift is recognizing that uncertainty is not the enemy of intelligent analysis. In fact, uncertainty is what makes markets function. If outcomes were guaranteed, there would be no reason for buyers and sellers to negotiate prices in the first place. The goal isn't certainty. The goal is awareness. Awareness of trends, awareness of risk, and awareness of how rapidly narratives can change when underlying conditions evolve. Moments like the one implied in this title, declining short concentration, tightening inventories, and the possibility of forced covering, serve as reminders that the financial system is dynamic. It constantly adapts to new pressures, new technologies, and new economic realities. What looked stable 5 years ago might look completely different 5 years from now. And perhaps the most empowering insight for viewers is this. Understanding these dynamics doesn't require being a professional trader or institutional analyst. Anyone willing to study the structure of markets can begin connecting the dots. Over time, that knowledge builds confidence. Not the kind of confidence that assumes certainty, but the kind that comes from seeing the bigger picture. So as conversations circulate about inventory drains and positioning shifts in the silver market, the real takeaway isn't a prediction about what will happen on a specific Friday. The real takeaway is the lesson about how markets evolve under pressure. When supply tightens, when participants adjust risk, and when sentiment begins to change, the system responds. Sometimes gradually, sometimes quickly, but always according to the same fundamental principle. Markets move where incentives, supply, and human behavior intersect. In a world filled with noise and speculation, stepping back to observe those deeper forces can be incredibly valuable. It turns headlines into case studies. It turns rumors into learning opportunities. And it transforms moments of market tension into lessons about resilience, patience, and awareness. Because at the end of the day, the story behind titles like this isn't just about silver. It's about how financial systems adapt, how narratives evolve, and how individuals who stay curious and informed position themselves to better understand the world around them. If you found this exploration valuable, take a moment to support the channel by liking the video, sharing your thoughts in the comments, and subscribing for more deep dives into the forces shaping global markets. The more we learn together, the better equipped we become to navigate an increasingly complex financial landscape. And as always, stay curious, stay disciplined, and keep looking beneath the surface. Because sometimes the most important shifts are the ones happening quietly, just before the world finally notices.